Okay, good morning. Welcome to the delayed final webinar in our move to Portugal virtual roadshow. In this webinar, we'll be giving you an overview of the Portuguese tax system, non-habitual residence scheme, and what issues you need to address before you move to Portugal, and what you need to do to ensure you plan successfully retirement and some inheritance tax issues. So in this webinar, we're joined by Adrian Hook, partner at Blevins Frank Portugal, replacing Matthew Kissman, who was due to speak, but unfortunately has been taken ill. Adrian will introduce himself in a moment. Before I start, I just wanted to say that we're here to support you at every stage of your journey as you move to Portugal, and we're happy to answer any questions you may have. So please submit your questions using the link on your screen during the webinar. We'll answer whatever we can during the session, and if we are unable to cover any, we'll follow up afterwards by email. For those of you watching the recording of this webinar, please send any questions to me at expats@expatnetworks.com, and I will either answer your question or find someone who can. Okay, so perhaps, Adrian, we could start if you could give a little background about yourself and Blevins Franks.
Thanks, Nigel. Yeah, my name is Adrian Hook. I first moved to Portugal, well, I first stepped foot in Portugal in 2006. I'd known the senior partner that worked here for quite a few years prior to moving. And by 2007, I had moved here lock, stock and barrel, sold my house in the UK, brought the kids over and put them into international school. So I'm long in the tooth, but obviously we don't need to cast our minds too far back to remember what happened in 2008, 2009 and 10. Obviously, Lehman Brothers went bust at the time, and we had the financial crisis. Whole countries went bust, including Iceland. So the testament to the company and its robustness and the due diligence and the compliance that we have in place, the company is still here. The company itself has been advising expats since the 1970s. Won't need to cast your minds back a little bit further to remember the winter of discontent. We had 90% interest rates at this time, and people were trying to figure out how to get out of Britain as tax efficiently as possible. So the founding fathers of the company, Bill Blevins and David Franks, would structure UK affairs in a way to get out of the UK as tax efficiently as possible, and then move to sunnier climes. Bill Blevins then went, well, look, we're helping people do that transition, so why don't we go the other end and make sure that they stay compliant in the country that they're at their end destination. Of course, most commonly in the 70s, that would have been Spain, but we started to, the business grew, and then we opened offices in France, Portugal, Malta, and Cyprus as well. So we're an expanding company, and it's due to testament that we're all still here after the financial crash, and our clients are secure in our advice, making sure that they stay compliant and correct. So that's a little bit about Blevins Franks. Also, a point to mention here is a post-Brexit environment. The fact that we put ourselves in a Brexit-proof position before Brexit, the transition period, we made sure that all our partners, all our staff are fully regulated in the countries that they operate in. So it's that joined up compliance and also the regulational need for our clients to know that if you're a client of Blevins Franks and you're getting end-to-end advice, that all that advice is indemnified and regulated in the jurisdiction that you're moving to.
Okay, well, thanks very much, Adrian. Perhaps if we could start off by just talking about residency. First of all, what makes somebody become tax resident in Portugal, and what are the consequences?
Yeah, well, the EU allows each member state to set its own tax rules. So in the UK, to be tax resident, there's certain rules, and you can go to the Inland Revenue website and look at the statutory residency test. On that, it's a little light document. It's only about 105 pages long, so it's great if you're suffering from insomnia to have a read of it. But it tells you exactly whether you're tax resident in the UK or you've achieved non-tax residency status, which is very important, but I'll come back to that in a bit. In Portugal, there's two simple rules. If you're here for 183 days a year, or your principal private residence is in Portugal. So as soon as you pick up residencia in Portugal, you've declared to the Portuguese authorities that this is now where you live. So sometimes for our clients, it can be about more important of where they're not rather than where they are. Because if you move to Portugal and you've got your residency, unless you tell the Inland Revenue you've moved out and you understand the UK end, then it can be that you'll end up tax resident in both jurisdictions. So you've got to be very careful.
Right. Okay. And so when somebody is moving away from the UK over to Portugal, obviously they become tax resident in Portugal. Once they become tax resident, so they become subject to Portuguese tax and so on. Are the things that they should be planning financially before they move to Portugal, or can they just wait until they get here?
Well, we've always advocated that, the old expression is get your ducks in a row before you move. Taking advice before you move is critical. You can sleepwalk yourself into a tax trap if you're not careful. I.e., for example, some financial products that are very tax efficient in the UK are not tax efficient in Portugal. So a prime example would be an ISA, for example. The ISA is a tax-free investment vehicle, whether that be cash or investment ISA, and it's very, very efficient in the UK. However, under the Portuguese rules, even under NHR, which I know we're going to talk about later, it will become taxable. So the question is then, is there an intent to return to the UK? In which case it may be better to keep it. If there's no intent to return to the UK, in which case you may want to reschedule it to make it more tax efficient while you're living in Portugal. Another prime thing that needs consideration before the move would be your pension commencement lump sum, commonly known as in the UK as your tax-free cash. Now, the UK don't tax that, but Portugal will. So you have to be very careful that you make sure that you not necessarily don't need to take action on this, but you understand the implication of it.
Right. Okay. And what are the differences in income tax in Portugal compared to the UK? For those who are looking to work over there?
It's a really difficult one. I always think that it pans out the same. The difference in Portugal, when you're working in Portugal, you pay tax on the first euro you earn. There's no personal allowance per se. But on a pension income, there is an allowance of about 4,000 euros a year. But the rates are scheduled. But the main difference in Portugal, I think, to the UK is the ability to do a joint tax return. So it works very well if you're a couple coming to move, one of you's working and one of you's not. You can actually put in a joint return to reduce your overall banding. It pans out when you look at it. The less you earn, almost in Portugal, the worse it is. But you have got scaled rates up to 48% in Portugal and can go above 50%, depending on the level of your income. But usually I find that if you're working here, depending on how you're working, because you can be self-employed if you're a green receipt, then it's your national insurance. Now, in the UK, your national insurance contributions are catching up with Portugal anyway. So I think that's probably the major consideration. So if you're looking to move to work here, make sure you understand not only the tax implication, but also the social security implication.
Right. And are there taxes in Portugal that people would be unfamiliar with in the UK?
Not really. It's all pretty standard. You've got EVA, which is VAT. So it runs at 23%. Capital gains tax we're used to. The difference is in Portugal, I think capital gains tax is just slapped at a straight rate, whereas we get relief in the UK, you don't in Portugal. However, Portugal has tapering relief. So the longer you've owned an asset, then the less capital gains tax you have to pay on it. So the systems, and I did an analysis about 7 years ago on somebody selling a property. So would it be better if I sold it as a Portuguese resident or a UK resident? And actually it panned out pretty much the same. There wasn't a lot of differences. The calculation was different, but actually the amount of tax paid was pretty similar.
Right. Okay. And so when people become Portuguese resident, do they pay tax only on assets in Spain and income in Portugal and income in Portugal, or is it everything in the UK and elsewhere as well?
That is a brilliant question, Nigel. And I commonly get asked that. The way to view this is the Portuguese tax system has one thing very much in common with the UK tax system, is it taxes you on your worldwide income and gains. So it doesn't matter where that income is arising, and it doesn't mean you necessarily have to pay any tax on it. However, it's reportable. So your worldwide income and gains are reportable in Portugal, and it's exactly the same if you're a UK tax resident and you've got a rental property in Spain, for example, or Portugal, France, or Australia. You have to declare that income to the Inland Revenue, and it's exactly the same here. Sometimes, sadly, that advice is not fed through. So people that have moved here, not picked up NHR, and then have remained paying their taxes in the UK, and then being told that no, it's okay if you're paying your tax in the UK, you don't need to pay it here. That is incorrect. You do pay tax in the UK. You might not have to pay any more tax here, but it is declarable. And nowadays with the communication between tax authorities, you will get caught out. So you've got to make sure you do it correctly.
Right. And so can you live in Portugal and stay UK tax resident?
Well, the Inland Revenue would be more than happy to keep you. Unless you tell the Inland Revenue you've left, they will carry on taxing you. Yes, it's possible to be tax resident in both jurisdictions. The difference is then, of course, is the reporting requirement. And if there's a mismatch on what the UK are taxing you at, and say that the Portuguese work it out that you've got to pay some more tax, that would be the position. So in essence, the answer to your question is no, because you will still have a reporting requirement in Portugal, which must be met. So you can be tax resident in both jurisdictions, but then those jurisdictions will fight over each other who has the taxing rights. So then you become a tug of war between two different tax jurisdictions, and you don't really want that to happen. So you need to be clear: is it one or is it the other?
Right. Okay. So you mentioned the non-habitual residence scheme. Obviously, that's one of the major sort of differences in Portugal to pretty much any other country around in Europe. Could you perhaps explain the regime, how it works, and what makes it so attractive?
Yeah, NHR, don't be fooled by its name. It's called the Non Habitual Residency, and it's just a tax coding. So when we look at the Portuguese legislation on taxation, there is a thing called NHR. It's just a tax coding. So, for example, one of my clients that has got NHR, their tax return looks identical to my tax return, apart from they've got a tick in the box, whereas I do not. I moved to Portugal before the introduction of NHR. It was rolled out first in 2009, and this was the Portuguese trying to attract wealth and high net worth occupations to Portugal, and it's been incredibly successful at doing that. The whole idea of it is that they will only tax what cannot be taxed in the jurisdiction. So in other words, if we had pension income from the UK, that can be taxed at the UK, but the UK gives the taxing right to Portugal. So Portugal tax it. So Portugal, up to 2018, we're taxing at 0 on pension income. So if it can be taxed, then the Portuguese will exempt it. Here we have a mishmash. Let's imagine ISAs, which cannot be taxed in the UK because it's a completely tax-free product. Then the Portuguese have the right to tax it. So it's a complicated bit of legislation. However, it can work very well, especially for retirees. And if we imagine, you say not many other countries have this, but of course, Britain has had this kind of scheme for years. I mean, we only have to look at the local news or the news in the last few days with Rishi Sunak's wife. She had non-dom status. So she didn't have to pay tax on overseas income if it is taxed at source. So it's an old tax trick. It's been around for years. The difference is the Portuguese brought it down so it applied to everybody. Whereas in the UK, non-dom status, you have to pay a ticket, a premium to be able to pick up that status. So then you've got to work out if you're a non-UK passport holder and you're living in the UK, do you pay your 30,000 a year or not? In Portugal, they went, We don't actually mind. Anybody can apply for it. What we want is we want you here. We want you spending your money here. And then it becomes more about indirect taxation. If you're living here, buying houses, filling your car with fuel, going to the restaurants, you're providing jobs and a tax take on an indirect basis. But for an individual, it means that you can have either nowadays pension income is only taxed at 10%. There's exemptions on capital gains tax if you're selling a property in the UK, for example. So it is a very good and very nice piece of legislation to be able to work around. One thing I enjoy about my job is actually making sure that all that fits correctly for a client when they move.
Okay, and so you've got, so you say 10% on pension income. What about investment income? How's that? Is that tax? Does that depend on what the investment is?
If remember, the one thing about NHR is that only covers income that's outside of Portugal. Anything in Portugal, you're fully taxed on. And that income is made up with, it's called exempt with progression. So if you're earning income from outside Portugal and you've got income in Portugal, you'll be taxed at the highest band. So it's put on the top. Investment income is an interesting one because it depends on the jurisdiction. Sometimes you get clients leaving the UK and they may have a UK independent financial advisor or bank, for example, that may advise that they go offshore with their investment. They may go to Isle of Man because that is the UK thinking. Actually, what we want is tax-free roll-up and gains inside it. However, Portugal have an aversion to tax-favored jurisdictions. So instead of 28% capital gains tax, you'll be paying 35% capital gains tax. So you are penalized. So again, it's critical to get the advice before you move. Investment income from any gains that are realized at tax at 28%. There are tax efficient products within Portugal where you can get the gains to roll up, but you are taxed on what comes out of it. So it's scheduling that correctly. So it works like an ISA, but there's a little bit of capital gains tax to pay out. If we hold, some of the audience may be familiar with the UK concept of platforms, where we can hold an ISA, a pension, a bond, whatever it may be. If we run that in Portugal, we will find the reporting requirement is extremely onerous because every time your manager buys or sells something, that's reportable. And if it's realizing a gain, it's taxable. So again, it's quite a complex area and you need to understand what product it is you've got, how those gains are realized. If it's providing dividends or capital gain, they're taxed differently under NHR as well. So it really is critical to take the advice before the move is gone. There's nothing wrong with leave everything the way it is, but understand the implication of doing that.
Right. Okay. And so once you're into the NHR, well, first of all, how do you apply? And then it lasts for 10 years. Do you have to stay for the full 10 years to take advantage or what?
Again, another good question. Well, post-Brexit, to get to Portugal, most of our clients are certainly using the D7 visa route. So this is a passive income route. There is a D6 visa when you want to come and work, and of course the golden visa. The golden visa is really geared around people that just want access to Europe that don't intend to become Portuguese tax resident. How you apply when you turn up in Portugal, let's say you arrived in April, you've got until 31st of March the following year to apply. It is a very simple process. You pick up what's called a NIF number, which is your tax reference number. That number is pretty critical in your life in Portugal. You end up usually memorizing it off by heart like a phone number. That number is then applied. You go from non-resident to resident NIF, and then whoever your accountant or your lawyer who did the application for you will be able to do an application for NHR. And it's not overly complicated. If you're fluent in Portuguese, you could probably go on the portal and do it yourself.
Okay. And what happens at the end of the 10 years? You just revert to full tax? Or?
You become a mere mortal like myself. You have to pay full tax. So again, I think it's critical, even though it only lasts 10 years, I'd say only 10 years, the older we get, probably, I don't know about you, but the quicker time goes, Nigel, the older you get, 10 years can go like that. I think one of the critical things is to get that pre-planning in place. So a lot of planning that we do would be dovetailing the type of Portuguese compliant investment along with pensions, along with any other asset class that we've got, to make sure that when we come out at the end of the 10 years, that we're not overly stretched from a tax perspective.
Right. Okay. And so, are there any other sort of financial attractions of moving to Portugal beyond the NHR?
I think the major one I can think, remember, people have been moving to Portugal, Spain, Cyprus, France for many, many years. The financial crisis brought about these particular tax advantages in some of the southern European states. I know that Italy's got a similar scheme, so is Greece, for example, and Malta for that matter. So I think that there's an element here that when I go to Spain or France, or I was back in the UK last weekend doing a seminar at Chelsea Bridge, the biggest financial incentive, I think, is the very low cost of living. Unfortunately, you've got a very low living wage here. So actually goods and services are provided very cheaply. So if you've built up a UK pension over the years and we've got liquid assets, we can actually use that to great effect here, because your euro will go a longer way. There are softer elements, I guess. I mean, I know you mentioned it in your beginning of your presentation about IHT, but it's a very, that's inheritance tax. It's a very complex area. Portugal has advantages over Spain and France, for example, where it doesn't have wealth tax and it doesn't really have inheritance tax. So there are other softer advantages, but after living here for 15 years, the biggest advantage is actually living here.
Okay.
If we let the tax tail wag the dog, it should be a lifestyle choice.
Yeah. Okay. So moving then to savings and investments. When you move to Portugal, do your UK investments remain liable to tax in the UK?
It depends what it is. It's an ISA no, but it becomes taxable here. Bonds, investment bonds, for example, are treated in the UK that you get your tax deferred. Whereas in Portugal, there's a tax calculation as it goes along, depending on the gains. Unit trusts or bear held or platform held investment structures, in the UK, you have an allowance, and every year your advisor will do best to take advantage of that allowance. In Portugal, there's no such thing, so you're taxed on every bit. If the UK, if it's paying dividends, then under NHR, it will be exempt because the UK can tax it. But if it's gains on a share, for example, that you're realizing shares, UK don't tax it, pass the taxing right to Portugal that then do tax it. So it depends. Unfortunately, there's no black and white answer to that. My choice is a very complex scenario. And what you got to do is understand what it is what is the investment, what it's held in, and then understand its implication.
Right. Okay. And what about capital gains? How are capital gains calculated in?
There's a flat rate in Portugal of 28%, and it depends what the gain is on. So let's take the gains from property. It's a very interesting one with property from a gains point of view of NHR. The Portuguese in that 10-year period that you're qualifying for non-habitual residency will exempt capital gains if it's charged in the country where the asset is, because it's a fixed asset. So we'll take the UK as an example. In 2015, under George Osborne's budget, if we remember, he introduced capital gains tax for non-UK tax residents on property. So he wanted, and his goal was to cool the London property market, and he managed to do it. It stopped the flipping of properties from overseas buyers, because now they were liable to the gains they were making over a couple of years. In the UK, we have that concept, thanks to Margaret Thatcher, of having our principal private residence tax exempt from capital gains point of view. And a lot of British people hold their wealth in the form of property It's usually people's biggest asset. So the fact that you can buy and sell your principal private residency with no capital gains tax implication is very attractive. When we look at that in Europe, most European states, if not, I can't think one that doesn't, there's certain allowances, but they all charge capital gains on your principal private residence, unless you're rolling it up. So all of a sudden you have this mismatch between the UK system and the Portuguese system. As a Portuguese resident under NHR, if we're selling a property in the UK, that's no longer our principal private residence because now Portugal is. So the inland revenue will tax it, but the inland revenue will only tax it from when you moved out. So if we move in 2022, but we sell the property in 2024, we've only got that 2 year of capital gains tax to pay in the UK, and Portugal will exempt the whole gain. So it's reportable in Portugal, but they will exempt it. Portugal has 2 ways to calculate gains on property. As a resident and as a non-resident, it's 2 different ways. And again, as I said at the beginning of when we were talking about capital gains tax and how it's calculated, even though they're 2 different systems to the UK, it pans out pretty much the same amount of money. The Portuguese are a great favorite of theirs is to use indexation. Usually, in my experience, clients that first move, and it doesn't matter whether it's to Spain or Portugal or France, they will usually keep a UK property. They will not immediately sell their principal private residence, or they may downsize. What happens is after you've been here 5 or 6 years, you can get life's lovely. I have a new network of friends. My family has grown up a bit more. So actually, I don't go back to the UK as often as I thought I would, and there's a slow change. And actually keeping a property in the UK can be expensive. If you're renting it, there's no real tax advantages because you're paying all the tax in the UK anyway. So most people choose to offload that and go liquid. As the older we get, the more simple we want our lives, but also to have liquidity, then we can make gifts out of our estate if we want. So to answer your question, how the tax is treated, it's pretty much muchness. But the non-habitual residency scheme is a great opportunity for people that bought property, might have had a property portfolio that bought it in the 90s, for example, because you've got all that gain up to 2015 with no tax implication.
Right, okay. And so are there investments in Portugal that are tax efficient, like an ISA would be in the UK? Are there any similar opportunities?
Yes, not quite as good as an ISA. An ISA is because the ISAs were born out of the old TESAs and PEPs. I'm sure some members of our audience will remember them, and they were designed to be able for people to give tax-free investment into markets effectively. And the TESA was the cash equivalent of a cash ISA today. Portugal reward people for saving in a different way. What they do is they allow there is a product, European savings bond, which allows roll up of income and gains within the product itself. So, and it's regulated from Portugal under the Pension Supervisory Authority. So yes, there are tax efficient products, and actually from our point of view, we commonly use them to create income for the client, but it's critical that it's protected, that it's in the right jurisdiction for the client. Most of our clients are at the end demographic. We don't have accumulators as clients. Normally we've got spenders as clients. They've accumulated their wealth over their lifetime. So the security of that wealth becomes critical. And minimizing the tax take on it, of course, it's a reduction in yield for clients. So actually having that structure, there are a few of them available. However, you've got to look behind the structure and understand its security is how secure is the structure, how secure is the company that's providing it, what funds you invested in, for example, to create that income become critical. So in a nutshell, yes, it is, but do you due diligence on the providers?
Right, okay. Returning then to the property, which you mentioned briefly, in terms of rental income from UK property, how's that taxed in UK, Portugal?
It's all taxed at source from the UK point of view, but remember, all reportable in Portugal. So I'll give you two examples. One example for somebody living in Portugal with NHR, and one example of somebody living in Portugal without NHR. And let's say they've got an income up to the nil rate band, so 10, 12, 15,000 a year. If this 15,000 a year, if you're here with NHR, you'll receive that tax exempt. So again, reportable in Portugal, but it will not be taxed. If you're here without NHR or at the end of your 10 years, the UK are still paying it out gross because they're looking at your overall picture and going, you're below the nil band. Portugal will tax you on the first euro. So there'll be a mismatch. So Portugal will start taxing you on the income that is generated from the UK. So for somebody here under NHR with rental income, in the first few years, it's tax neutral because there's been no tax paid. You're paying it all in the UK and reporting it here. But post NHR paints a very different picture. You become fully taxable on that income in Portugal.
Right, okay. So then moving on to pensions. Question here, if I pay my pension into a UK bank account and move to Portugal, where will it be taxed?
In Portugal.
So
you would declare it. It doesn't matter. Remember, you as a Portuguese tax resident, you've got to declare your worldwide income and gains. So it doesn't matter where the money is going or where it is. If you've been paid it, it's declarable and taxable here.
Now, I believe there's a difference with the civil service pensions. Is that right?
Correct. There's certain firemen, policemen, for example, any government scheme, because it's called a superannuation scheme, are taxed differently. That is where the UK government goes, we don't care where you live, we're going to tax it at source. So again, you get your allowances in the UK. So it can come a position where you're paying tax in the UK in your first 10 years, it's neutral, you're declaring it here. But after you drop off into NHR, you might find there's more tax to pay in Portugal.
Right, okay. And just to return to that 25% lump sum, that, just to clarify that will become taxable, assuming you're not on NHR, if you're in Portugal when you receive it, is that correct?
Yes, I mean, NHR, remember, all pension income is taxed. It doesn't matter if it's lump sum or income, is taxed at 10% now.
Right.
The maximum under the new rules that because Portugal tweaked the NHR to keep Northern European states happy, because Sweden, not so much Denmark, Sweden, Holland, France, Germany were all upset that their citizens were living here and not paying any tax because it was nil rated. And so a couple of them started to take action. Finland, for example, in 2018, when any pension, any income that comes out of Finland, we're taxing it at source. We don't care where our citizens live. Sweden did the same this year. If you're in 2022, if you're Swedish and you've got a Swedish pension income, it is now taxed as it leaves Sweden. So I call that doorstep taxation. It's critical to understand that Northern European states can change their tax rules to negate Southern European attractive tax schemes. So from your pension lump sum, from a UK perspective, it is free, tax-free, 25% of the fund you can take. It's commonly known as tax-free cash. Technically, it is just a pension commencement lump sum. So if we take that as a UK tax resident, then it is free. If we take that 25% as a Portuguese resident, tax resident, then we've got 10% to pay on it. So again, that planning element is critical. It goes back to your first question, Nigel. You know, what steps do we need to take before we move? Do we just truck up and do it? Because you can miss opportunities to minimize your taxation without doing it the correct way.
Right, okay. So finally, let's just sort of cover inheritance tax. And, you know, you mentioned that earlier, but could you explain how that works? How's it different in Portugal than in the UK? Okay.
The first thing we have to consider here is our own domicility of origin. Inheritance tax is not based on income or gains. It is about your accumulation of your wealth over your lifetime. And the difference between Portugal and France, Spain for that matter, and the UK is in the UK we have common law. And in the France, Spain, Portugal is Napoleonic Code. So Napoleonic Code deems that a dead person can't own anything. So once you die, whoever your inheritors are, they've got it. That's it on the second that you die. In the UK, we have the concept of an estate. So when we die, we still own stuff. We still have that concept of an estate. So in Portugal, they only are interested in what's in Portugal. So it's geographically linked. From a UK perspective, they'll charge that tax on your worldwide assets. So the Inland Revenue will look at everything you've got, and anything over 650K, they will charge at 40%. So it's a big, big problem for a lot of our high net worth clients, although nowadays it's not even necessarily high net worth that are worried about it or ultra high net worth. It affects more and more of our clients all the time because the rates aren't going up as much as asset values could be increasing. So if we've moved to Portugal, that doesn't mean that we've broken our domicility of origin. If we've got a British passport, which is deemed from our parents, then we are deemed UK dom. So it doesn't matter where we go in the world, we're always considered domicility of origin. The only way you can break that is to acquire a domicility of choice or a domicility of dependence. And the domicility dependence may be that if I married someone that was dependent on them and lived in that country with them, then I could apply for domicility of dependence. Domicility of choice is when you've moved to a different country and you've gone, I am living here now, I intend to die here. And you break all your UK connections. And we as a company have gone through all the past cases where the Inland Revenue have challenged deceased estates wanting to collect inheritance tax and looked at the kind of things that the Inland Revenue pick up on to be able to go back and attack and go, no, they clearly had an intent to return. And this can be stupid things, sometimes like golf club membership, a UK bank account, or a burial plot in the UK, for example. If we look at Richard Burton, that became Swiss, he lived in Switzerland. And when he died, the Inland Revenue took 40% of his estate because he had a burial plot in Wales. So you're looking at, it showed an intent to return. So picking up a domicility of choice is a very, very difficult thing. And it's a lifestyle choice as well, because you've got to be committed that you're not going to go back to the UK. I would say out of all my clients, only about 5% of them would have achieved a domicility of choice. So it needs careful planning, which is why I mentioned about that if you dissolve or liquidate UK fixed assets, so in the form of property, then you can start to gift out of your estate because it's a potentially exempt transfer. And if you live for 7 years after you've made that gift, it's outside of your estate. Pension planning is critical in this as well, because the pension pot itself is deemed to be outside of your estate until you reach the age 75. So there's careful planning to be put in. From a Portuguese perspective, it's not charged. If it goes directly to dependents, it's no problem. And they're only interested when you die and go through probate in Portugal, the probate only deals with your Portuguese assets. Where in the UK, probate deals with your global assets because they want the taxation on it, of course. And I'm sure that a lot of the listeners and viewers here have gone through UK probate with deceased families. Sadly, I lost my wife a few years ago to breast cancer, and I had to go through UK probate and probate here. And it can be a very long process from the UK. Here, it was very, very simple. But in the UK, it took quite a bit of time. So it's making sure again, preparation is critical. So if we're going for a domicility of choice, we do an analysis for the client. give them our professional opinion that yes, you've shared your domicility of origin and now have a domicility of choice, and you keep that document and you keep your intentions with your will. And in that way, you can speak to the Inland Revenue from beyond the grave. Because remember, you're going to be dead. The Inland Revenue is going to be coming after your deceased estate, and it's your dependents, whoever your executors are, that have to argue that point for the Inland Revenue. If you've got it all documented, that makes their job significantly easier.
Right. Okay. Yes, my father-in-law, when he died, had all of his paperwork in his bedside table. He was clearly ready, and
Yes,
in both senses of the word.
Sadly, if you plan it correctly, it makes the recipients of the estate's life significantly easier.
Yep. Okay, well, I think that has covered the ground, so many thanks, Adrian. So let me just sort of finish by thanking everybody for listening. As I said at the beginning, we're here to help you at every stage of your move to Portugal. And if you have any questions or would like us to refer you to anybody in our carefully chosen network, an extensive network of service providers, please don't hesitate to contact us on expats@expatnetwork.com. And those of you who are ready to make the move, I just would like to mention our discovery tours, where we can get you a tour of the area you're looking to move to in Portugal with one of our partners, and then we'll take you around and get you to understand the area. Even if you've been on holiday, you often don't understand what it's like to actually live there, and therefore, you can identify the areas that are perhaps covered in holiday lets and very noisy, or where the internet is very poor, or whatever, those sort of practical details. So it's about finding the right location rather than the right property, and as I say, there's no obligation there. So if you want to find out more, you can go to our website, and under events you'll see discovery tours there. So many thanks, and thank you for joining us. Good luck, and many thanks, Adrian. Okay.
Thank you, Nigel. Take care.
Bye.
Okay.